In this video, I'm going to go through the question Alfred Scott, a question involving the conversion of a sole trade business into a limited company. This question is in your question pack. You can see it's question 1 in the relevant section of the question pack. So just reading through the question and discussing some of the key features of the question which will guide us in the solution. So Alfred Scott operated as the sole trader in a restaurant business for many years, and he decided to convert his business to a limited company. And on June 19th, 2019, he did so under the following terms. So all of the assets and liabilities other than cash were transferred to a new company called Alfred Scott Limited. Okay, and Alfred Scott issued Alfred 50,000 ordinary shares, 10 euro ordinary shares at par, fully paid him 15,000 in cash, and created a loan account in his favour in the sum of 10,000. Now, this is the first little piece of information that's of significance. In return for the assets of the sole trade, there was shares, cash, and a loan account paid by the company. Okay, so when we're trying to figure out the value of the shares, we have to compare the assets transferred against these elements. So that'll be one part of our solution that we'll be looking at. Now, you're given then details of Alfred's statement of financial position, balance sheet at the date of the transfer are as follows. And you can see that there's sort of fairly typical balance sheet elements, and I've got a few of them highlighted as they need to be kind of discussed in a little bit more detail. So we've got our non-current assets or fixed assets, buildings, plant, machinery, and goodwill, and these are the carrying values, the accounting book values. They're essentially irrelevant for the purpose of what we're going to be doing. What we have to look at is the market value. So this column here is going to give us all the values of the assets when it comes to calculating any gains or losses. So in a sense, you can disregard the accounting values. It's the fair value, fair market value of the items at the date of the transfer. Now, the ones that I've highlighted here with a red arrow, these are typical assets that give rise to gains. These would appreciate in value typically. So you're looking at the land, the buildings, and the goodwill. These items in general have the potential to appreciate in value. Plant and machinery is ignored. Essentially, plant and machinery used in a trade will not give rise to a gain or a loss, typically because it declines in value, and you don't get a capital gains loss relief for such assets either. So these three assets, these three categories of assets, will need to be have some calculations performed to figure out the gain or loss that arises on them, and we'll be using the market values of each of them for calculating that gain or loss. We'll have to look at the market values compared to the original historic price as indexed where appropriate. I've highlighted using an orange colour the cash balances. These are essentially ignored in all of our calculations. So when we're looking at what's been transferred, we ignore cash, and while it's stated in the parentheses up above, that's always the way that you ignore cash in these transfer situations. Looking at some of the notes underneath, okay, you've got your liabilities there, but looking at the notes, the land and buildings were purchased as follows. So you got land was bought for 250,000 with a current use value of 10,000. Okay, so it was bought back in 1980. Now, CUV, current use value, okay, an abbreviation. So what that tells me is the land is development land, and all the restrictions that apply when calculating a gain or loss on development land will need to be brought into our calculations. So again, a little sort of a crossover point there, that while this question refers to conversion of a sole trader into a limited company, we will need to apply development land restrictions to part of our solution. The buildings, okay, you can see they were bought for 300,000 and then extended, so we have enhancement expenditure there for 150,000. This sentence here, all of the plant and machinery qualifies for capital allowances. It's another way of telling you that you can disregard plant and machinery for the purpose of capital gains tax. It's restricted really to income tax, okay, but essentially disregarded. Now, included in the value for trade payables is the sum of 26,000 representing a personal income tax liability of Alfred, for which Alfred Scott has agreed to assume responsibility. Now, that's a kind of an indirect way of saying that apart from giving Alfred some shares and some actual cash and creating a loan account, they're actually going to pay off a bill for him. And that's treated the same way as if they had given him cash. So this sentence here will need to be factored into our calculation of the value of shares. Now, you're asked to compute the capital gains tax implications, if any, of the above conversion, and advise Alfred of a possible means of reducing any tax liability arising when structuring the conversion. So I'm going to switch now to the solution, and we'll go through the process. So in my solution, I'll need to calculate gains on land, buildings and goodwill. I need also to figure out the value of the shares. We know the value of the cash, we know the value of the loan account, and we know the value of the tax liability. So the value of the shares must be a balancing amount. And then we can look at the deferral which is available under these types of transactions. So I've got the solution screen now displayed, and the first step is compute the gain or loss on the relevant assets, the buildings, the goodwill and the land. So we're going to be looking at the sales proceeds, or specifically the market value. I'm going to maybe highlight those words in red just to make them stand out, because that's what I would be taking from the question. And we deduct original cost and enhancement, or the balance of cost depending on the nature of the asset, as appropriate and indexed. So for the buildings, the market value is 1.3 million. The original cost was 300,000, and the index based on the date of construction or date of purchase was 3.24. The enhancement, the extension, was another 150,000 with a different index. So my total deductible cost is coming in as 1.15 million, and I have a gain on the buildings of 149,000. Goodwill is much simpler. Typically goodwill is generated rather than purchased. You don't tend to actually write a check to buy goodwill if you set up a business from the start. So the market value of the goodwill is 2 million, and there was no cost applying to it. So there's a gain of 2 million on it. So that's obviously going to have quite a significant tax impact potentially. With the land, the market value is 600,000. Current use value, worth noting that it's just the current use value that I'm using to as original cost. And then the balance of the purchase cost, 240, is not indexed. So we have a gain on the land of 327,600. So total gains there on this transaction as things stand of almost 2.5 million euros. Now, thankfully, there is a relief, or I suppose a deferral of those gains. You don't have to pay tax on all of that just yet. So in order to figure out how much tax is due, we need to look at the value of the shares received. The greater this value, the lower your immediate tax payment. So what we need to look at then is what assets were received. So the gross value of the assets transferred. You've got non-current assets and current assets. And I've indicated there that we exclude the cash balance. Could be worth just highlighting that, maybe to make it stand out. So if I just momentarily go back to the question sheet, the 15,600 is basically the inventories and the trade receivables. So I excluded the cash balance, 15,600. You'll notice also that I don't take into account trade payables at this moment. So the gross value of the assets is 4.2 million. Now, how did the company buy these? What did it give Alfred for these assets? So it gave cash, which we know to be 15,000. It created a loan account in his favour for 10,000. The trade creditors were taken over, and the income tax was also taken over. So that's 26,000 taken over. So that's a total then of 125,000 in those elements, and therefore the rest of the consideration must have been paid for by shares. So the value of the shares is coming in as 4,075,600. So that's going to help reduce the amount of tax that Alfred will need to pay on this particular transaction. The fact that he received something other than shares, the cash, the loan account and the income tax being paid on the suppliers will have a negative impact on the tax bill for him. Okay, so we have total gains of 2,476,650. We know the value of the shares is 4,075,600. So now we're going to see how much of the gain is now actually taxable. So the total gains were, as indicated there, from step 1, and then we can see how much is deferred. So it's the value of the shares divided by the gross assets. Okay, the gross assets value up here. Now there is a special concessionary treatment available to a sole trader who is availing of this particular relief, but it's only available if the sole trader receives nothing but shares. And the nature of the concessionary treatment is that if you receive nothing but shares, you can include genuine trade creditors in your numerator value. Okay, now that's not available in this particular question because Alfred received cash and a loan account and had income tax paid off by him. But if that weren't the case, if these three elements that I'm going to select hadn't been part of the deal, okay, so he hadn't received cash, a loan account, or had an income tax bill paid by the company, so he only had these trade creditors being taken over, then you could actually add the 74,000 up here, so it would it would improve the deferred proportion. But that isn't available because he received things other than shares. So the gain before the deferral is 73,000 odd. He has an exemption of 1270, and his tax bill at 33% is about 24,000. Okay. The final thing I just want to highlight in this solution is this deferral, okay, how that's dealt with. Okay, so the deferral amount is 2,402,000, and what happens with that is you subtract that from the value of the shares, which we calculated in step 2. And if Alfred, maybe in 5 or 10 or 15 years, decides to sell the shares in the company, that will be the base cost of the shares. So the value of the shares was 4,075,000 from step 2, and we deduct the deferral. So if Alfred sells those shares maybe in a number of years down the road, his base cost will be 1,672,649. So if he sells the company, the limited company, for say €2 million, he'll have a gain of the difference between €2 million and this number here. Okay, so it'll be 327,351. And that completes that solution.